Hi, this is Zak Mir, editor of Spreadbet Magazine, with a look at some bulletin board hero stocks on Thursday, July the 17th. I'm starting off with Tyratech, where there's been a resumption of the rally here. We obviously had the big move up at the start of the year, January to February, where the shares essentially quadrupled. It looks like we're back above the rising 200-day moving average, just below 9 pence, and we've rebounded off the floor of a rising trend channel from the start of the year towards 7 pence on the daily chart. The view now is that we should return to the top of the trend channel towards 15 pence, also the post-March resistance zone. Maybe if you're cautious on the trade, you'd wait for a weekly close above the 200-day moving average, or even a break of the 50-day moving average, which has capped the price action since the beginning of May. So that looks like a constructive resumption there for Tyratech. Same sort of thing maybe going here on the Doriemus chart. We've got basically we had a bear trap rebound from below the 50-day and 200-day moving averages. 200-day moving average rising at 0.15 pence. And it looks like we're in the run-up to a golden cross between the 50-day and 200-day lines, and that should start supporting the shares over the next few days. The overall trajectory here on the daily chart is that we've been largely within a rising trend channel from October. That's based at the 50-day moving average level at 0.13 pence. And if this charting configuration is correct, over the next 1 to 2 months, we should start heading up back towards the best levels of last year, and then maybe even higher at 0.35 pence plus, as was previously forecast before this little dip we had for the start of July. Finishing off with a situation which was one of yesterday's biggest movers, London mining, and looks like we've got a sort of cup and handle formation coming in here with this rebound off the 50-day moving average at 41 pence. This could lead back to the top of a falling trend channel and form a February resistance around the 80 pence level. That's also just below the 200-day moving average at 83 pence. So it looks like a sort of an intermediate rally, even if it's not a rally which ends the decline from November resistance way above £1.40. The stop loss on the buy argument, really an end of day close back below the 50-day moving average at 41 pence. That's it from me. More updates at spreadbetmagazine.com.